Thank you, Jeremy. Thank you, everyone, for attending today. My name is Shalin Madan. I am the co-founder of Sidrania Fund Services. Sidrania Fund Services is a third-party administrator, vertically integrated. What that means is that Sidrania owns its own technology to do full general reconciliation. For hedge funds, Sidrania is the leader in cryptocurrency fund admin with over 500 clients now, and large swaths of the market, including DeFi, which might be the reason I'm here today. But enough about me. I'd like to introduce our wonderful panelists today. And why don't we start it off with Allison Russ. Allison, why don't you tell us a little bit about yourself?
Yeah. Hi, good morning, everyone. My name is Allison Russ, and I work at Figment. And Figment's goal is to increase adoption of blockchain technology. So we provide infrastructure solutions for proof of stake blockchains. And for today's conversation, I'll be focusing more of the yield conversation on staking or protocol staking, which is when token holders stake or lock their token onto the blockchain and help maintain the ledger and earn compensation in the form of newly minted tokens and transaction fees.
Awesome. Kenneth Estes of Diffuse, why don't you tell us a little bit about your organization and yourself?
Oh yeah, I can do. Thanks for having us here today. I'm Kenneth Estes, co-founder, CEO of Diffuse and Diffuse Digital. Diffuse Digital is a fund incubation platform. So we launch various funds primarily in crypto. The area of focus for two of the funds is Decentralized Finance, or DeFi, which is trying to take services traditionally done by financial institutions and taking out the institution. So a lot of value add. So we have two funds that are trying to generate yield using these various DeFi protocols, one of which is a market long, one of which is a market neutral, no crypto exposure strategy.
Awesome. David, out in the West Coast, why don't you tell us about yourself and FalconX?
Hey guys, I'm David. Thanks for joining today. So FalconX is a one-stop shop for the world's leading institutional cryptocurrency market participants. And essentially, we're providing technology, security, and reliability to power the strategies at scale. Most of our clients are hedge funds, both crypto native, traditional finance. We also work with corporate treasuries and other participants in the space. And essentially, what we're really trying to do at FalconX is productize cryptocurrency and put it into a way that people can understand, both if they're deep in crypto, as well as if they're new entrants that are coming into the space today, by providing them trading, credit, and other services surrounding cryptocurrency trading and the needs that go along with it.
Wonderful. I'd like to also mention that Sidrania is plugged in very nicely with Diffuse as a client and FalconX as one of our API connections. And then lastly, we have Brad Coppin of Brevan Howard Digital. Brad, I think we know Brevan Howard. Why don't you tell us a little bit about what Brevan Howard Digital is?
Sure, Brad, it's great to be here. So I come from a traditional trading background, but I spent the last 4 years in crypto working with a digital asset trading desk and crossing over with venture capital. And Brevan Howard Digital is a new fund being launched by Brevan Howard to give institutions access to digital investments. And that's going to be a broad variety, but we're just getting started. So the details on that are sort of to be determined still.
Awesome. So yield has come up a couple of times, and you've heard it as well in these initial introductions. So what I'd like to do right now is define what yields are, where are they coming from in DeFi, and are they real, scalable, and here to stay? So with that, I'm going to start off with Kenny.
Sure. I think we all have different flavors of yield. So I'll talk about the DeFi one specifically because that's kind of the core of what our actively managed funds do. I mentioned decentralized finance is trying to do everything financial institutions do, but take out the institution. That creates a lot of efficiency gain, right? Like institutions aren't particularly known for being efficient. There's a lot of bureaucracy and golden parachutes and executive comp to kind of make things more expensive than they necessarily have to be. So decentralized finance, there's two services that are reasonably mature in decentralized finance. I'm saying things that, the purists out there would probably argue about, but in my category, in my my understanding, there's two buckets. One is lending, more traditional banking. So make a smart contract that borrows X and lends it Y, and you make a spread between Y and X. Like, it's pretty straightforward. That was where DeFi started, and candidly, the yields have come down significantly since then. The more lucrative and where we typically play is market making. Interestingly enough, I too have a more traditional finance background. I was a high frequency trader for, a decade. So Brad and I have that in common. And so in market making, it's a way to do what traditional market makers do. Normally you do bids and offers, but here you're using a market making pool, smart contract, where the liquidity providers are investing in there. The pool is facilitating conversion and paying rewards to the people that are staking or invested into those pools to allow it to have enough liquidity to, facilitate liquidity conversion. So that's where we spend most of our time, is some flavor or another of market making. Now that is fundamentally very scalable, right? That is a super big value add. You can do it more efficiently. You don't have the arms race that you have in more traditional HF in market making with microwave towers and low Earth orbit satellites getting information from Cermak to London a couple of microseconds faster, right? That doesn't exist in this space. So it is a new paradigm, which is really, really exciting. Canada has a little bearish on crypto in general until we saw a really good use case like this. So it is scalable, but it's new. And as if with new, it is the Wild West out there, man. It's hacks, it's scams, it's, things just not working. I like to use the example of one of the protocols had a really high yield. We couldn't figure out why. We went to go try to invest in it, and the UI was broken to the point that for some completely arbitrary reason, we had to add 8 zeros in front of the number before we could actually deposit it. Like, that's the quality of a lot of these protocols we're dealing with. So, but that's okay, because candidly, circa 2002, traditional finance infrastructure looked a lot like that as well. So if you're okay dealing with that risk, dealing with the duct tape and barbed wire that is the entire space, there's a lot of inefficiency, which is where you're able to generate alpha. So I do think it is scalable, and I think we're effectively, even though we're a year and a half into the DeFi paradigm, I think this is still the first inning. We have a long way to go to scale this thing up.
Great. Brad, I think that Brevan Howard is involved in yields perhaps in a little bit different way. Maybe you can talk about that.
Yeah, so I do need to give the typical disclaimer, is that all the views I talk about here are my own and do not represent Brevan Howard Digital, and is not investment advice. But yeah, some of the other yields that you find in crypto, particularly starting with DeFi, is Kenny mentioned inefficiencies and rewards, where there are all sorts of inefficiencies, particularly in capital efficiency, where you may need multiple assets to trade. You might need to borrow some of those assets, and there are multiple places you can borrow and lend from. That creates some inefficiencies within that fragmentation. And on the reward side, a lot of these new projects that come out, they have multiple types of reward. They might have a yield reward, where you get paid to lend an asset, or you get paid to trade on the platform. And that could come in the form of the fees for trading. And it also comes in the form of the native token of that project. They could give you some of their own token as an incentive to try their product. And that's very similar to traditional sort of like customer acquisition, where how many emails do we get per week saying that if you sign up for a Chase bank account, you'll get $250 if you meet all these criteria. There's very similar rewards in DeFi, where you get incentivized to try new things, to use the projects, and the interoperability of all that does create some leverage on those opportunities, which creates some of the yield that we find in DeFi.
Great. Allison, do you have any comments on this topic?
Yeah, I think protocol staking is a great juxtaposition to what Kenny and Brad just mentioned. So the yield is sourced in a much different way. So in protocol staking, you actually serve as the infrastructure for the verification of transactions on the blockchain. So you are actually working on behalf of the blockchain, and you're earning rewards in the sort of two flavors. There's an inflationary component that is set at a blockchain level. So when you participate as a staker and are working on the blockchain, you actually get a piece of that inflation pie. And the inflation target varies by blockchain, but it's set on the onset, and it's very clear sort of schedule of inflation. And then also you do earn transaction fees as people operate on the network. Unlike other parts of DeFi, it tends to be a much more stable and sort of predictable yield source. And again, you're providing this solution that's really inherent to the blockchain operating, because someone has to verify the transactions. And so the rewards accrue to you as the token holder serving in that capacity.
Awesome. I can hand it over to David or anybody else. David, I don't know if this is completely up your wheelhouse, but let us know if there's any comments you have.
Sure. Yeah. So the way I think about yields in crypto is generally that a lot of the more traditional lending, like what FalconX does, borrowing from counterparties, lending it out to our clients, etc., follows the lines of more traditional prime brokerage. And there's a huge delta between what rates are in crypto for crypto funds versus what you see at normal prime brokerage desks. Everybody in traditional finance is talking about rate increases, but rates in crypto are at least 10x higher for cash. And a huge reason for that is just because of access, right? It's a supply and demand problem. There are less dollars in the crypto ecosystem for crypto companies like hedge funds, miners, etc., to borrow to enact the strategies and services that they're normally used to when they're coming over from traditional finance. So folks that are coming into the space that have a market neutral, high frequency trading background in TradFi can have a prestigious track record, come into crypto and have trouble sourcing capital in this space to lever up their strategies. And it's not because people don't believe them, it's because people are a little bit wary about crypto. To take a step back, I ran a fund in traditional finance as market neutral. I ran a market neutral crypto fund for a couple of years. When we think about what happened back then, like in 2017, 2018, 2019, I did a lot of lending arbitrage between the different counterparty desks that look like FalconX, where I'd borrow from one and give to the other because the market was fractured. What you've seen over the past couple of years, and especially over the last 6 months, is that rates generally have become depressed. Leading up to like May, June, 13, 14% borrower rates for dollars was not something that was weird. It was normal. Since June, rates have come down, and I think a lot of that has to do with just there's generally less leverage in the market today. But it's also because there's a large influx of people that have come in on the institutional side with large pools of capital, and they are generally adding to the supply. And so rates still remain elevated versus traditional finance today, but they're definitely kind of on a downward sloping curve for the normal borrow lending that you would see at a prime brokerage.
That was phenomenal. It's 4 different viewpoints of what yield actually means. I love it. I'm going to be arbitrary here. People can ask questions. It's perfectly fine. I'm going to try to save the Q&A for the end. However, there was a direct question posed to FalconX, so I'm going to repeat it. Does FalconX treat its crypto loans as quote unquote securities for purposes of US securities law?
Yeah, so the loans are structured under a normal lending agreement with FalconX. And, it's covered under a master borrower agreement or master lender agreement, depending on which direction we're going with the loan, whether we're borrowing or we're lending out.
Great. Okay, moving on. Emerging coins generate the most attractive yields, but how can allocators profit without putting their capital at risk? Brad, I guess, why don't we talk about risk versus reward, audit, legal regulatory risk. That's something that we spoke about yesterday, and something that you're focused on.
Yeah, definitely. I mean, I think about risk, particularly when it comes to DeFi, in 4 different buckets. One of those buckets is financial risk, right? Is, what is the reward I'm going to get for this strategy? And then, how does that risk and that reward, work together. And then more on the risk side, you think about there's security risk, where I think this question is a little bit about the security of assets, where I'm going to hold this asset, and how am I going to store it? Where is that asset going when it's going to earn this yield? And how do I manage the transfer of those assets? Can I keep that asset at a qualified custodian and still earn these yields? Those types of questions. That's really what we like to think about sort of first. And there are a lot of solutions out there for custody, whether that's with a third party or self-custody, to help manage that risk. I'm not going to say it's the easiest one to solve, but there are a lot of solutions out there. There's a lot more information out there. So that might be one of the more researched topics of risk. And there's also the technology risk, and that's mostly going to come down to smart contracts, right? If you're depositing assets into DeFi, those assets are going to a smart contract. Who created that smart contract? Has it been audited? Do you have the technical expertise to audit it yourself? How do you trust that you put those assets in there and those assets aren't going to be siphoned out the other end by some exploit in the code? I think one of the things that I learned throughout my career is that if there's code involved, there's always going to be bugs. And how do you sort of limit the impact of those bugs on these assets? So that's sort of financial security and the technology risk. And then depending on who you are, you have to think about different sort of legal and regulatory risks. Whereas, an individual, you probably don't need to be that concerned with KYC and AML and putting assets in a DeFi pool. But as you move up that institutional spectrum, there's going to be different risks that you need to consider for KYC, AML, and those types of concerns as you are putting assets to work in different types of strategies in DeFi. And that the answer to like what those risks are is different depending on who you are, where you sit, and how you view those risks.
Great. David, I guess FalconX is not doing anything publicly in the DeFi space, but perhaps you could talk about liquidity and safekeeping, and any other risks that you deem relevant.
Yeah. So when I think about risk, I think of like the modern portfolio theory curve, right? Low risk, low reward, goes up to high risk, high reward. Sometimes you'll see stuff that's offset that line, right, in the middle, where there's a little bit extra alpha for you to capture. But generally speaking, right, like one of the hardest things about crypto is that there's a lot of newness surrounding it, right? Like I like to always think about it, it's just another asset class. And once you've been in the space for a while, it very much functions like that, but there's nuance surrounding everything from custody to platform to counterparties. Everything is new. And those new things create barriers to entry because it almost feels like you got to bang your head against the wall to really understand crypto from a intermediate level. If we take a step back though, like at the end of the day, especially in today's market, right? The market today, not what it looked like 2 or 3 years ago even. There is a variety of ways that you can interact with the crypto market. Folks that look like FalconX, we pride ourselves on building trust with our clients. We only work with institutions, and we've been in this space for a while. Essentially, what we're trying to do is productize crypto, make it easy for people to come into the space. With that being said, there's probably opportunities that exist outside of FalconX that have a higher risk and higher reward that are attached to them. And so, like as you think about kind of risks and reward, the way I generally think about it is like platform and security is paramount in crypto. You don't want your crypto to be stolen. Then you also have, if you're playing in the DeFi space, you've got protocol risk and auditability of the contracts. And then you kind of go out onto the curve with how big is that contract? How much support does it have in the community? And you kind of keep running through what would look like a fundamental counterparty review for these decentralized companies. And so if you want to come into crypto and start easy, it's probably easiest to go to a centralized counterparty name that you've heard. You can conduct a normal due diligence process. And then once you're kind of in the space, you can start going out and entering into the fringe and getting into some of the more esoteric DeFi platforms.
Absolutely.
That might be my cue. Is esoteric DeFi platforms. That's right up my alley. And I think that's to jump in on the question there. David and FalconX are trying to productize crypto, which I think is ambitious. Brad and Brevan Howard are trying to make it more institutionalized, and Allison's doing more the non-custody type things. But that does leave these kind of more esoteric things that are, like I said before, it's the Wild West. It's messy. There's security risk, like both Brad and David have said thus far. Custody is terrible. Like for what we do, there's no custodian that can do it, period, at all. We're going to end up having to create our own custody solution. I'm glad there's no custodians on here because everybody's too focused on Bitcoin and Ethereum and not like all of the down the rabbit hole. So if you want the fiscal controls, that security that Brad was talking about, it doesn't really exist. But also, things like underwriting and making sure that everything is valid. Test transactions, like you'd be astonished if you get down the rabbit hole, which is kind of where we're playing. You do a test transaction, you try to put $1 into a protocol and then take $1 back out. About a third of the time, it doesn't come back out. Right? It's pretty bananas out there, and these are like audited smart contracts, so it's really bizarre. So, but I think that there, if you're really risk centric, put that top of mind and try to think through how you can mitigate this or at least diversify as much as humanly possible and do that intelligently. That very inefficiency and the fact that FalconX isn't necessarily down where we're playing because they haven't productized it yet that far down. That's where the opportunity is. That's where the alpha is. That's where you can make money.
Kenny, on that, we've talked about, and it's getting to be a little bit of a played out example, but it's still fun to discuss the iron finance situation and sort of, situations where investors can see triple digit yields and all of a sudden it just kind of just disappears and collapses. Maybe you can explain what you saw in real time and how maybe even Diffuse, underwrites those sort of situations.
We tend to avoid algorithmic stablecoins. That's what that was. So the basic logistics is that there's like, I think it was 70% collateralized, meaning that there was actual like hard assets, pegged assets that were collateralizing against the iron finance token. That was the one. Mark Cuban was shilling it. Like it was a whole big thing for a while. And then it started to slip. So that's another risk that is specific to stablecoins is the peg risk, right? The peg should always be worth $1 if it's a USD pegged asset. If that starts to slip, you should start getting worried, right? That's a non-zero risk, especially for algorithmic stablecoins. So in that particular situation, we were in it. We were in iron finance. But we knew before going in exactly how the arbitrage mechanism worked so that you can create and redeem these tokens, whatever. And theoretically, if the price is below some value, then you can make free money. And that's how they incent people to keep the peg in line. So when the peg started slipping, I went in there and I'm like, okay, we know what this mechanism is. Theoretically, it should be it. We did the arbitrage mechanism and we lost $1,000. And we're like, and out, hit every bid, just get out of the pool because there's no way this goes down well. And then, we just watched Telegram and kind of chuckled and watched the mortification as people lost a lot of money on this because, and this goes back to the recurring theme, they didn't really understand at a deep level how this stuff worked. They saw Mark Cuban say that you can get 150% return and you go in there and no, that's not real. Or, more recent example would be Ohm Finance. You can get a 5,000% APY, but like, no, that's super dilutive. That number means literally nothing. And then it tanks when people realize that. And like, that was one we were just like, this is stupid. This just fundamentally doesn't really work. So we just avoided the whole thing. But that does require a certain mindset of, no, I'm not going to do the kind of top level stuff. I'm going to get into the weeds and actually understand how this stuff operates in a deeper manner than just kind of casual yield maximization.
Allison, do you have any thoughts on this topic?
Yeah, I'm in agreement with everything that everyone just said. And it's interesting hearing Kenny talk because, from a traditional portfolio manager's perspective, operating in traditional finance markets, right? Like the risks just aren't the same. They're not the same. And if they are the same, they're just it's harder to do that whole risk return analysis that you would on traditional securities. And I'm also laughing hearing Kenny talk about watching Telegram and like, these are real news sources and this is how this industry operates. It's just not that the securities are harder or new to evaluate. It's that like the communication behind it is also different. But a risk from the protocol staking side that is unique to protocol staking is something called slashing. And that's when a portion of your tokens that are locked on the network are removed for you acting as a bad actor, essentially double signing a transaction or double spending a transaction, which creates all sorts of chaos on the network. So that's very much a risk that exists in staking or in DeFi that would not translate over to traditional finance markets.
Yeah,
Excellent.
I really like
Yeah, go
how
ahead.
you both highlighted risk as the biggest thing, because a lot of this, particularly from what Kenny was talking about, iron finance, it's financial experimentation. So like, just like in traditional side, if you're going to put assets to work, you really need to understand the risks. And as Allison said, that's a little bit harder here because it's new, right? Some of this stuff is new. It might look and feel in some ways like traditional finance, but there are nuances to this that not everybody understands. And if you're going to put assets at play, you need to understand those risks. And the story that Kenny tells about iron finance is they understood the risks better than other market participants. So they're able to maybe, not have as much risk, not lose money in that situation. Those same things happen in traditional finance, where the people who understand the risk better tend to not lose as much money in a bad event, and they tend to make more money in good events. And the same thing is at play here. It's just more socialized, so there's easier access, and not everybody understands the risk, which is why you see a lot of events where people lose money.
But in that same vein, I'm starting to look at what is the risk for people not participating? You as a portfolio manager, a financial advisor, whatnot, like you're missing out on real returns if you do the due diligence. And so that can be argued that that's a risk, is the missed opportunity. And I think we are sort of at that inflection point in the industry where portfolio managers and advisors and folks are saying like, hey, we do have to dip our toe in the water, because of course there are these risks, everything that we just talked about, but we owe it to our clients to make sure that they're participating on the upside as well.
Yeah, to that point, Allison, you made me think of early in my career. I was a trader for a REIT focused fund. We invested in REIT preferreds and corporate bonds, and our target was if we hit 5% return a year and 5% yield, we were hitting an absolute home run. And you come to the crypto world, and like you can sneeze and get that from just lending out USDC or dollars or whatever. And I think it's a really good thing to bring up, because there is risk at not participating in the space. And I just think about how hard we work to get a 5% yield and a 5% return in 2000, or before the financial crisis. And it's just the game has changed. But just like then, like we were REIT specialists. I traded on a biotech fund for a while, and you know your space and you know your domain really well, and that's how you find your alpha. The same thing can be taken back to crypto. There's going to be generalists, and there's going to be specialists, right? And folks like Kenny that are in deep into DeFi are going to be able to find the arbitrage opportunities that exist, but only exist to a small subset of people because they really truly understand the technology. I guess the point though is sometimes these yields are too good to be true. It's probably too good to be true.
One thing, David, that you brought up earlier was modern portfolio theory, and echoing that, and with Allison's comment, right? It's high risk, high reward out there, right? Certainly compared to traditional finance. Now, if you're a more traditional allocator, if you don't believe that crypto is on the efficient frontier, you are wrong at this point. Like fundamentally, the rewards are there. It's a relatively mature asset class. And if you do buy into the fact, modern portfolio theory 101, that this is on the efficient frontier, the only question is how much of your portfolio should be in it. It's not zero by definition. It might be 50 bips, 100 bips, but it's something.
As a hedge fund manager in my night job, I'd also say that modern portfolio theory also assumes the risk-free rate is risk-free. So I think that kind of creates a lot of problems as well. Not a crypto manager, but it definitely poses a lot of issues for the traditional 60-40 portfolio, and certainly, as Allison mentioned as well, it's really hard to underwrite, any level of return, frankly, for a 60-40 portfolio. So, crypto and digital assets and DeFi absolutely have a place. I'd also mention in my day job as co-founder and chief growth officer of the leading crypto fund admin, back office risk is something that people don't think about, especially if you're starting a fund. There's probably only one handful of third-party administrators, people who do your books and records effectively, who can handle this sort of asset class because it is insanely complex. Kenny talks about these new protocols. Well, if Kenny's studying a new protocol and investing it, then well, so do we. And we have to figure it out. And then we have to create a full general ledger that it's going to be passable for not only audit, but for the SEC. So there's when that regulatory risk does come. So there's when people are thinking about a back office provider, it's certainly that they have to be cognizant of those risks as well, because it's very, very important. I think we've kind of talked about hacks and scams. I don't know if I'm going to leave that open to the group if anybody wants to talk about how you protect against hacks. Scams that may be probably easy. Obviously, if you're doing your due diligence, you'll skip a scam. But how do you protect against hacks?
Yeah, so I can kick this off. So the way I think about it is there's a handful of things that could be hacked in the crypto world. You could have centralized counterparties like a FalconX and our competitors. You can also have the underlying protocols that are in decentralized finance applications, and then even for something like staking potentially. So it really depends on what part of the market you're playing in. But in this world, there's a handful of different types of insurance that you can get for it. You're also trusting potentially balance sheet of a centralized counterparty. In DeFi, you don't have that opportunity necessarily. But there's one of the things that got me comfortable with decentralized finance personally was companies that are out there that are writing their decentralized insurance companies. And there's surrounding a lot of those issuances out there, and there's been some good ones and some not so good ones. But it really got me comfortable to take money out of my Bank of America savings account and throw it into decentralized finance on Compound and earn a 14% yield, and then write an insurance policy against it in case my assets got taken from me. And the policies themselves are ranging 2.5–3% on an annualized basis, which seems massive, but if you're going out and you're getting something that looks like a 10+ yield, and then you're paying a third of it for security and kind of allowing you to be able to sleep at night, it actually ends up being still a pretty good reward versus what you can get in the normal traditional financial system.
Okay. Great. Allison, did you have any comments on?
Yeah, from where I sit, hacks are a little bit less relevant because protocol staking is non-custodial, meaning that you maintain control of your private keys. So yes, they could be hacked, whether you're keeping it at an institutional custodian or not, but that sort of reduces one level of risk there. I mean, when you're looking to work with a provider on protocol staking, looking at the slashing record, track record is very key. Engaging in something like an insurance coverage, as David mentioned, is also very key. But all of that is sort of on chain, at least the slashing record. So you can, if you do your homework, you can identify where risks could reside.
I think, obviously having not a single point of failure as well with respect to the key is very important. And I know the custody providers all have different ways of doing it. And, we're being approached as well in terms of being some of that trusted, kind of holder of a key. So that's something that I'm actually learning about as well. And it's fascinating how everybody has a different view on this. Okay, great. Our next topic is on technology. So what infrastructure do you guys think would propel crypto, DeFi, crypto yielding to an institutional level? I'm going to start with Allison on that.
Yeah, so obviously the blockchain is the basis of DeFi. Most DeFi transactions occur on Ethereum, and you saw some layer ones last year get their foot in the door. But we think that the lion's share of activity is going to continue to take place on Ethereum. We are looking towards this beacon chain merge, which will solve or help solve some of the issues that currently exist on Ethereum. And it has this sort of first movers advantage, aside from operating largely well, that make institutions comfortable to engage in the system. So that's sort of at the blockchain level. And then as you think about operating within the space, the continued refinement of custody partners and custody solutions, making it so that it's easy for people to plug and play is really, really important. And you have portfolio managers or folks that have been operating in traditional finance markets for years, and they just don't know where to begin, frankly. Do I start on the custody side? Do I start on the trading side? Should I dip my toe into the staking water? And so education as a whole, and the ability to sort of walk people like hand in hand through the setup process and investing and how to operate is really, really key, I think, for getting institutions engaged. I mean, there's obviously that regulatory holdup and hang up and lack of clarity there. And my opinion is that will continue to exist for at least some period of time. But to the extent that people can be educated and can feel like this is an approachable marketplace, I think that's the first step for getting the institutions engaged.
Brad, when we were discussing Brevan Howard's digital asset fund, it sounded a lot like a multi-strategy digital asset fund with the third in venture, still a bit of work in progress, I'm sure, but a third in liquid directional and a third in yielding sort of strategy. So what sort of infrastructure is required to execute a strategy like that?
Well, it's similar to what I said earlier. It depends on where you sit, right? So Brevan Howard is going to be a little bit different than my previous firm, which was a proprietary trading firm, which is a little bit different than a family office or an individual, right? So, we're definitely focusing on security first. So as Allison was highlighting, we might be starting from a custody perspective, right? Where we're going to use a third-party custodian, quote unquote qualified custodian, and some of those custodians now offer access to DeFi, usually in the form of staking, where if we owned Ethereum, we could stake that Ethereum into ETH 2.0 and earn a yield out of that. If we and that for a proof of stake chains, we could sort of earn that staking yield with having assets in the custodian. And then that's sort of like from the custodian standpoint. But then there are also ways where you can take self-custody of assets and earn yield through yield farming, staking on your own, and cutting out that middleman so you're not paying that fee. But it depends on like what risk you're willing to take, right? Like all of these questions and all these topics come down to, I love that Allison brought up education, is you need to educate yourself enough to understand the risks you're willing to take, to understand the risks you're not willing to take, and figure out what path is best for you depending on like how you're investing, right? So investing proprietary money, internal capital, is different than investing third-party capital. The rules are going to be different. How we think about those risks are going to be different. So I'm sort of in that process of transitioning from I've done this stuff on my own. I've done this stuff from a proprietary trading model, and now I'm moving to a more institutional hedge fund model. So the rules are going to be different, and we have to adjust to those rules and the risk tolerances because they are different.
Mm-hmm, mm-hmm. Kenny, how does Diffuse, discuss technology, at an institutional level with some of your bigger investors?
Yeah, so technology obviously is a big part of what we do. Custody, we've touched on it a couple of times now. Like there's really no good solution out there, and the ones that do actually require significant dev integration to get them to work the way we want to. We're probably honestly going to have to build an in-house solution at the end of the day, unless something changes fundamentally in the next month or so. Because Allison mentioned the beacon sharding stuff for Ethereum. And that is trying to solve a core problem with Ethereum that you really can't do much for less than a couple of $100 on Ethereum, full stop right now. And that's any size transaction. That is really inefficient. really inefficient, to the point that a lot of what we do and a lot of what really active traders do is avoiding Ethereum at all costs, right? Like it's just a nightmare. And maybe when the beacon charting comes in the next, whenever, 2 years, that will change, but you're seeing Ethereum losing significant market share to all of these other blockchains. And as I've harped on a couple of times, the inefficiencies are where the opportunity is. So for us, like we're trading across 6, 7 different blockchains. We're wanting to expand that, rebalancing on a daily basis. Like you have to do the whole automated solution in addition to the custody piece. And then the risk tooling on top of that. So it is very, very developmentally heavy. Now, I think the technology for institutionalization, if you're, I'm trying to think of a good example. If you're Barclays Bank, right? I don't know why I went with them, but I did. You're not going to be managing private keys anytime soon. Right? You're just not. It's just so far departed from your workflow that you're not going to get there. But you can sign a loan agreement with FalconX, right? And then they can do the complexity that's involved with moving things around on chain and getting counterparties and all of that. So there's a huge need in the market right now for institutions to get in there to partner with somebody like FalconX. Eventually, right? That some of them will decide to do that in and of themselves, and they'll get comfortable with private keys. And my general belief is that the entire financial system, it's not a matter of if, but when it becomes entirely digitized. Full stop. Fiat money goes away in the traditional sense, even if it's pegged to the fiat dollar. And that has a lot to do with macro concerns, but it might take 100 years. I don't know what that is, but the current system is not particularly well set up. And so when that happens, they'll have to solve a lot of these problems, but we are many years away from these folks being able to do anything significant. And in the meantime, there's going to have to be third parties like FalconX that are providing these institutional on-ramps for them.
Yeah, I just want to highlight one thing there, because it did sound like Kenny and I were maybe contradicting each other, is that the custody piece is sort of in place for the big high market cap tokens like Bitcoin, ETH, maybe the top 20, give or take. Right. And that's being built out. But as Kenny has said, if you want to play in the assets that have the higher yields in DeFi that are farther down that market cap list, then custody is sparse or non-existent. So there is sort of, and that goes to show just a difference in risk too, right? To have to self-custody it is a different risk. So the reward's a bit higher generally in those type of assets than the assets that you can custody with a custodian, because the risk there has been removed. There are more participants in those tokens than there are in the tokens farther down the.
I think as we can all agree that the level of innovation and the number of tokens and coins that are being added to these platforms is just increasing exponentially every day. So it's definitely that's definitely a positive, I think, for the growth of the market overall. David, FalconX, obviously big on technology. Maybe you can talk about your thoughts on technology in the crypto space.
Yeah, so I think one of the most common questions when people are first entering crypto is like, how do I view my holdings? Like they're used to being able to go to a prime broker or going to an institution and just having a file that's delivered to a system for them every morning. And they know how much Apple stock they own and Google, and these are their fixed income securities, and that's it. And then you make some trades, you send it to your admin at the end of the day, and you're done. In crypto, and we've touched on this, the world is significantly more fractured once you want to start playing outside of the top assets. Like even something like Solana. Solana was like 2021 was the year of Solana. It went from a sub 100 coin to top 3. Now it's about top 10. Large swath of the largest institutional custody providers either just started it this year or haven't gotten there yet, and they don't support. A lot of them don't support things like staking, which is one of the cool things about Solana. And so a lot of times when people are coming in, that's the first question, like, how do I view my holdings? How do I aggregate up all these different wallets? And so what we see a lot is we see people that come in and say like, hey, like I need a solution that will just kind of fit my workflow for today, right? Like I need a place to start. I want somebody that can do custody, that can do trading, that can do lending, can do yield and treasury management, all in one space. From there, right, like the goal of that company, like what FalconX does, like we're really trying to continue to service that institution as they grow and get deeper down the crypto rabbit hole. there's always going to be folks like Kenny who come in and we just help him on everything that he wants to do. But you know, like basically the way I think about it is that you know, there's a basically like the pace of technology in fintech is outpacing general technology around the world, I would say. If you think about crypto compared to that, crypto is a warp speed ahead of what that technology and what the institutional counterparties can do in the crypto space. Institutional crypto technology is always going to be playing catch up. And we're trying to develop things as quickly as possible. And our goal is to capture as much of the market as possible to give people like safety and security that they and trust that they're looking for. In addition to that, give them some of the ancillary services that are unique about crypto, especially surrounding yield and treasury management, and wrapping that under something that feels familiar. But to the point of like some of the stuff that Kenny's trading, right, on the fringe of DeFi, new blockchains, new tokens, they don't have institutional support, they don't have institutional custody. There's a variety of ways to help out with that, but we're always going to be playing catch up. But I think the goal is like provide a unified front. The other big thing that I see in the space is that there's a lot of counterparties that like to work together here. The pie's still growing in crypto. We're not taking slices from each other, and a lot of counterparties that would definitely be viewed as competitors in TradFi are, you know, working together in crypto to help build a more holistic solution.
Awesome.
One thing, Shaylin, I want to plug Cedrania is to that point about getting down there and finding aggregated reports and all those things. That's kind of a fund admin's job. And I'll tell you right now, we talked to every fund admin on the street, and Cedrania was the only one that could even support part of what we do of actually pulling transactions and turning them into reports and things like that, which is pretty cool. And that's a very deliberate decision on your part. And it's one that relieves a massive, not market opportunity, but it sets you aside from the pack in a pretty major way.
Thank you, and I appreciate that. And you know, I think we have 150 technologists on staff now, really building out tools for the crypto community in the back office. And certainly, I appreciate your support and our 500 other funds that we have.
I think something else to highlight is, and I think everyone on this call can appreciate it, is there's still a lot of room for growth in terms of the infrastructure around crypto to make these things easier. But it's also really impressive how far the industry has come, right? Is thinking about I've been involved since 2017 in a very serious way. It's amazing to see how much has changed to have these institutional offerings like FalconX and Figment, fund admins that can handle DeFi. Like these things did not exist in 2017. So in a very short amount of time, the products and solutions that have been built to help make access to these assets and these strategies easier has been really impressive. There's obviously a lot of work to do on that front, but it has been impressive to see how far the industry has come in a short amount of time. And I expect that trend to accelerate over the next couple of years as well.
Matt Levine has we love Matt Levine, and he has a thing about basically digital assets is just reinventing everything that relearning rather everything financial services learned over 200 years in about 2, right? So it's just the sheer pace of innovation. Granted, they end up just coming up with new terms for old things, but then also things people in Brad, like I love your comment. People don't realize, I started in TradFi HFT in 2002, right? The tech stack was worse than it is in DeFi. Right, like, and it's where we are now is very, very far away from that, and that's a couple of decades. And
that's a wonderful analogy.
Going the same way through, yeah.
Thanks, Kenny. That's a great analogy. I love it. Okay, this is the fun question. It's like so I can everybody start taking notes now. Okay, where do you find and take advantage of the most attractive yield generating opportunities in 2022? Basically, give us your best pick. Leading it to the floor. So we can start with Brad.
I think the best opportunity is going to be something that we wouldn't even point out today. It's February. I think in February of last year, if you said the best opportunities was in NFTs, you would probably be the only one to say that. And yet the best opportunity across crypto last year was in NFTs. So I think the most amazing thing about the crypto ecosystem is that it's constantly evolving. I think the best opportunities this year, people aren't talking about yet.
Yeah, that's a great point. Anybody else want to answer? Kenny, I guess, you're on the buy side. Maybe you can. or do you want to keep your portfolio secret?
Exciting new things. There's a section of, I would say, decentralized global workforce is fascinating. That's a catch-all term, and I don't know what that means, right? But so NFTs led to the play to earn economy. Axie Infinity went from like no revenue to like 3 billion in revenue last year, right? And the idea is now you can have, we did like a little test program there. We hired 6 dudes in the Philippines that played this game for us, and we shared their rewards. So it's kind of like we stake them, kind of almost like a poker game, to be honest with you, a little bit. But the key thing was we hired them with a QR code. That was it. That was the entire interview process. We hired them with a QR code. They deliver or they don't. We just track them, right? And it's really straightforward. And that's hiring people across international lines and all of those other things. And you're seeing this. So that game in particular is not that interesting. It's basically Pokemon. But if you can use that same scaffolding, that same infrastructure of hiring these lower wage workers in this decentralized manner to solve real world problems, like SEO or things that you still need the human eye on, right? Not SEO, but like analyzing documents and checking things in research, kind of delivering on the promise of Amazon Turk, a decade or two ago, whatever it was. That's really interesting because then you have a global workforce, and you're seeing that kind of happening at the same time of the rise of DAOs, decentralized autonomous organizations, which is a decentralized company, theoretically. Again, to quote Matt Levine, they're reinventing things like shareholders and management versus shareholders and stuff like that. But it's really interesting because it's taking people from all over and finding a way for them to, on a technological basis, interface and solve real world problems. So there's 2 trends that are happening towards this decentralized global workforce and how to coordinate them. The fascinating thing for me personally is, what does a regulator even look like in that environment? The SEC ain't it, because having a geographic regulatory body trying to regulate a globally decentralized workforce, it makes zero sense, just fundamentally. What does a decentralized regulator look like? This creates all sorts of these weird problems that we're going to have to figure out as we continue down this track, but I fully expect that we will.
Allison, I'm going to throw a little zinger at you. Where can investors find information to learn about risks and return opportunities in this space?
Yeah, well, you can go to like more traditional sites like coindesk.com. There are some great podcasts out there. Kenny does one of them where you can participate and learn on the space. And then you really should be looking at places like Telegram and Twitter because a lot of news flow does happen there. And I think it's really about inserting yourself in the mix and know that it's going to take a while to build that foundation. But you have to start somewhere, and it's hard to go from 0 to 1, particularly in this field, and particularly when, things operating at exponential speed or exponential growth is like an understatement. But you have to figure out a way to get your foot in the door. So again, you can go on coindesk.com every day and read the headlines, and that's a good place to start.
I learned this entire asset class, not nearly at the scale of yourselves, but through the comment section on Twitter. And that's what led us to acquire a third-party administrator about 1.5 years, 2 years ago, and build.
Yeah, and I encourage people to sorry, Sean. I encourage people to that you don't have to start with a lot of assets to engage, and that's the beauty of all of this. You can stake 1 token. You can do a lot of things. I mean, aside from operating on Ethereum with $100. So learn by doing, and pick your threshold of what you're not afraid to lose, and just put yourself into the mix.
I love that by doing mantra. It is, except for Ethereum gas fees, it is sort of cheap, and I'm not going to say easy, but you can figure out, you can do it yourself. And I think that is the best way to learn and educate yourself, is read first, but then experiment, because that's the best way to learn.
David, I'm kind of going to the Q&A here, so another zinger for you. what are your thoughts about crypto in the real estate and mortgage industry? Yeah, or I'll leave this to the entire group. Your thoughts on securities tokens.
Yeah, I think look, I think it's definitely going to go in that direction. You're seeing some folks do it currently today. You got folks like Figure out of San Francisco, Mike Cagney's company that is doing mortgages on the blockchain, refinances both for student loans and mortgages, right? And essentially their pitch is like, hey, we can do this better, faster, cheaper with better technology, save you about 35% on your refi. I think that's like stage one of kind of where we're at today. The future, like if you think about like what took down the world in 2008 and 2009, it was packaging up a whole bunch of mortgages and valuing that package at something different than what it was actually valued at. And one of the problems is that the underlying got lost in translation when it got sold from all of these different big banks. With something like crypto and blockchain, like you actually have the ability to do look-throughs. So if you're doing repackages of mortgages as ABSs, you're able to actually, like using blockchain, using smart contracts, you could have a full look-through to what that portfolio is and what it is and where it originated from. And so I see tremendous value in the space. I think that the biggest thing there is like the regulation team. They need room to grow, and really we need clear defined rules and what can be done in that space. And I think that'll be developed over time. I was a huge fan of what Overstock did. I think it was about a year and a half, 2 years ago, where they issued a digital token. Basically, a whole bunch of people were shorting the stock, and they issued a digital token which forced everybody to cover. And I thought it was really unique, and they took advantage of kind of a inefficiency in the marketplace. But like, there's a lot of companies out there that could do the same thing. At the end of the day, like issuing shares or fractionalization of paintings of companies, whatever, like the blockchain was built for it. And it makes it really easy to interact with. But there's a lot of room. There's a lot of room to get to where we need to get, and a lot of that has to do, to me, with just the technology that exists today, as well as where we need to be from a clear regulatory structure.
The last question, I'm going to take a stab at it and let anybody else answer. But what do you feel institutions would need to invest broadly in this space? And my answer to that, personally, is a unified regulatory framework. I don't know if anybody else has a better answer or a different answer. But I think that just having come myself as originally an institutional allocator, then family office guy, then part-time hedge fund manager, then crypto admin guy, I should say. That's the one thing. I think that, we're seeing rules being piecemeal together. We're seeing drops from some of the SEC officials in terms of what a regulatory framework could look like. We ourselves are working with various organizations like AMA and Chamber of Commerce's to really help form that regulation, because the back office is really where that regulation is going to come from. But that's my answer. I don't know if anybody else has a different answer.
Okay. I have thoughts if you want. So
sure. Yeah.
So Allison, thanks for the plug. We do every Wednesday at 10 Central, we do a Diffuse Tap. It's a virtual event. Allison was on a couple of weeks ago. It was a great session. Most of that's crypto investors or alternative investors, and a lot of it is networking in small groups. So if anybody's interested, hit us up on that. One of our speakers many months ago made a comment that's really stuck with me. US is at a severe risk of becoming a digital backwater. The way that our regulators are handling the current situation is completely understandable, right? Because we are the international reserve. We just are. The US dollar is. Our financial system is the largest on virtually every measure that you can come up with. China, arguably maybe is in there somewhere. And so we have the most to lose as a country if more and more of the financial infrastructure becomes decentralized. And the position that the US is taking right now is a direct consequence of that fear and that uncertainty and that lack of knowledge of what's going on. They're acting as though they are in the driver's seat, but they are not. If you want to go ahead and say it is, these stable coins are now banks in the US, what's going to happen is the stable coins are going to be issued not in the US. It is a global phenomenon. It is very easy. The people that are doing these things are incredibly mobile and distributed across the world. So for the US to go out and to try to think that they're, the same paradigm exists that's been there for the last 100 years, where the US is kind of deciding how everything goes and then everybody else falls into lockstep, that is not what's happening right now. So to say that, so I think that that's the first thing that needs to happen is the US needs to change that mindset of like, okay, how can we come together to form a global, to your point, Shaylin, unified regulatory approach?
I think the Oscar music, when they play it at the end of the speeches is playing right now for us. So I want to thank everybody for your time. I'm going to hand it over to Jeremy. I think there's some questions that weren't answered. Apologize for that, but everybody's emails are going to be distributed. And again, thank you to everybody, and thanks for the invite to moderate this panel.